This is Siglinde Perry, and I will be discussing fiscal management for my group presentation. In this presentation, we are going to take a look at the definition of fiscal management. We will look at the functions, as well as the costs, budgets, the characteristics, how tax status plays a part in social service agencies, as well as how to avoid any common mistakes, and then we will conclude the presentation. So what is fiscal management? Fiscal management relates to anything financial, especially revenues and expenditures and debt, and anything that refers to policies on taxation, spending, and borrowing. Fiscal responsibilities consist of budget, controlling costs, investment planning, as well as tax status. Functions of fiscal management include obtaining, allocating, and controlling scarce resources. It also helps to develop and formulate long-term strategic goals. The ability to set long-term goals is to plan out future long-term direction. As well as managing new projects. You need to know how to evaluate projects, to seek and evaluate new initiatives so that you can compete and profit in the industry. You also need to estimate and forecast future cash flows. The future cash flows of any agency is what creates value for business over the course of time. And then it's important to monitor and control of expenditures so that you can carefully identify the necessary expenditures required for any operation. And ultimately, you want to create a decision. Anytime good fiscal management process is in place, the result is more efficiently run businesses so that they're better equipped to quickly ascertain whether or not to proceed further with a task or to shut it down early in the process. Therefore, you're saving your organization both time and money. Other functions of fiscal management have to deal with the assessing changes, and that would be whether your revenue, expenditures, as well as service utilization. You also want to monitor patterns in services and expenditures, as well as analyzing any program costs and unit service costs that may impact the agency, and you also want to take corrective management actions in fiscal management. One good thing to identify in any social service agency is to identify the mission. And with that, most agencies do have a mission statement. However, if no formal mission statement exists, the first thing that people tend to look for are the IRS forms, which usually run on 1023s or 1024s, any funding proposals, any annual reports, any strategic plans, and even minutes from the board of directors from the agencies, in which most agencies usually do have a board of director that actually makes the calls the shots for the agency, as well as any past IRS tax returns. Other things to look for when it comes to fiscal management are costs. With that, you have fixed costs, you have variable costs, your mixed costs, as well as your total. And to plan effectively, a fiscal manager must understand and evaluate these particular costs. The fixed costs are expenses that the company incurs, but they don't change with the changes that go on with the levels of activity. So, for example, if your company is renting a warehouse for storage, the lease typically will not change, or the amount of the lease will not change based on how much inventory you can fit into that warehouse. An example of a variable cost are basically your reasonable cost above basic support cost. So that could be the cost that it takes to take care of your client or whatever special needs that they may have, because they vary. An example of mixed cost in any agency would be your phone and internet usage for service. So in addition, if your service employs people, in which in most cases that's almost every organization, then wages would be a factor as a mixed cost. So the fixed element is a basic wage. However, if your company is paying overtime or you give out performance rewards or even bonuses, then those salaries would then become a mixed cost. And then for total cost, of course, that's the sum of all your fixed and variable costs, in which using managerial accounting tools, most owners are able to, or managers are able to look at total cost and work backward into the fixed and variable components, which is also known as cost analysis. And this can be helpful when forecasting costs. Additional costs include direct and indirect costs. In agencies, your direct costs are usually going to consist of personnel, salaries, wages, if you're having to hire outside consultants, if you're paying your mortgage, any rental or leased equipment such as like your copy machines or anything like that, any supplies, as well as just the care, the cost of the care for your clients. Indirect costs typically consist of rent if you are not owning your the building for which you are running your organization, any supplies, even insurance that you may be paying, as well as legal and professional fees, in addition to any money that you're paying out to train and develop your staff. What is a budget? Budgets put a business strategy into play. It also helps to allocate resources, and it provides incentives for managers to control spending, and it also helps to communicate plans and expectations. A budget is needed to plan for the future so that managers can carefully monitor their input and output by comparing it with their budget and to secure financing. The first thing that banks or any lenders are going to want to look at is your budget so that they can base whether or not they're going to give you a loan. A budget is usually based on a company's fiscal year. However, budgets need to be reviewed at least quarterly, and monthly is actually preferred. Some agencies create budgets with the help of like budgeting software, or simply by just revisiting previous budgets. And then what happens after the budget is created is that most managers tend to compare the forecast with the actual numbers, in which they then reassess and then they learn from previous numbers. And then that way they can ask any questions about any expenses that may not look common. On to revenue. Revenue can consist of your earned income, which typically consists of fees for service that you bill your clients, or even membership fees. Of course, revenue comes in the form of grants and contracts. Gifts can be cash, whether it's pledged or planned giving, or it could even be in-kind gifts such as like donated services and goods. Investment income, of course, could include, but it's not limited to, like savings accounts or even interest from CDs or dividends from stock investments. And your patient income would be if you were billing insurance companies for services. Some of the characteristics of a financially healthy nonprofit is ensuring that there is sufficient income to ensure stable programming. If you go hiring too many people and the need's not there, you could potentially put yourself in a dire situation in which you're not able to pay your staff and you're not able to provide service, as well as always making sure that there's an internal source of cash or cash readily available. I think a lot of businesses jump into it thinking that they'll get by, but they don't have the source of cash readily available in case of emergencies. And then there's also making sure that you engage in income-based rather than budget-based spending. And with that, income-based budget usually is based off of realistic income projections rather than basically guessing. You know what to expect. And with that, it helps to determine realistic goals for your next year's service delivery through analysis of last year's cost. And it also helps to consider the current market condition. And again, because you don't want to execute a program or service that's not needed, risk wasting any resources that you may have. Then there is obtaining a tax-exempt status. For any nonprofit, fiscal management, you need to be able to qualify for a tax-exempt status. And to qualify for a tax-exempt status, the agency has to be a charitable. They have to engage in charitable activity. They have to be willing to promote public benefit. The agency must recognize that the directors and the policymakers do not benefit financially from the activities of the organization. They have to be willing to make all financial and program transactions transparent, or basically allowing the public to see those figures, as well as willing to file the necessary paperwork that it takes to get tax-exempt status. And the two major components of maintaining a tax-exempt status is making sure that you renew periodically, and that means that you're receiving and you're reviewing tax forms, and that you're filing your agency with incomes of at least $25,000 a year. And then there's also making sure that you have continued responsiveness. And with that, again, you have to require proof that you are continuing to meet the tax-exempt status, that you're engaging in charitable work, that you're making financial reports public, and that you're not engaging in political activities, and that you, the board of directors and the volunteers, are not benefiting from the activities of the organization. Ways on how to avoid common mistakes. Always have realistic expectations. Making sure that you're using finance and accounting software systems. Being thorough and ensuring that the numbers do add up. Getting help from financial service professionals if need be. Making sure that you look at past costs and expenses so that there are no surprises. Also, setting aside those contingency funds. Monitoring tax implications and remaining compliant, and most of all, sticking to the budget. This concludes my presentation on fiscal management, and being able to effectively develop and implement and manage the financial systems of any business gives significant credibility to the leader, so that they are able to maximize these fiscal management principles, thus leaving the organization with a good reputation. Thank you.